The Dow finishing out the month of May with a loss. The S&P 500 giving back almost all of its gains. But the NASDAQ managing a nearly 6% gain, helped by enthusiasm for AI-related stocks. Our next guest says that the S&P and the NASDAQ have been getting all the attention, and under the surface there are some worrying signs. Joining us now, Jon Mackay. He heads an investment strategy team at Schroders, where he serves as the head of platforms for the U.S. client group. And I use the AI term there, and you just go right out and say it, John. You call it a frenzy.
It is. I think it feels a little bit like FOMO, right? So coming out of COVID, you had a lot of people piling into tech stocks. That was going to be the way of the world. Valuations got a little bit rich. You had cryptocurrencies running. And then, the bottom fell out, the floor fell out of those stocks. And it feels a little bit like that's happening with AI. There definitely will be winners. There'll be companies that are at the center of it that benefit from it. Obviously, NVIDIA is going to be a main player in that area. But it feels a little bit overdone. And I think if you look at the rest of the market, whether it's the equal-weighted S&P 500, cyclical stocks, the dollar, commodities, it's all telling you that a slowdown is coming. So I think the broader market is much weaker than the headline would tell you.
And we've been having this discussion about whether the broader market rises to meet some of the standouts, or whether the standouts are just, whether there's air pockets under some of those issues. I think you're probably in the latter camp. You think that the breadth not being very wide is an issue for the overall market.
I do. Yeah, I mean, look, you've got some great companies here, up on the screen here. They're not going anywhere, but I think the valuations that they're trading at are asking a lot of investors to take on that risk today. Great trade at the beginning of the year if you're able to get in then, but getting today is asking a lot of investors. And I think you highlighted it in an earlier segment with some of the retailers struggling because of a slowdown in the consumer. We're a 70% plus consumer-oriented economy, and the Fed rate hikes from a year ago and earlier this year are really starting to take their toll on consumer spending. So I think it's more likely that these recent winners come down to meet the laggards in the rest of the market.
The worrying signs that you noted, I would think would be on the Fed's radar. That's why yesterday I thought the comments from Mester were a little odd, saying there's nothing that I see that would cause me to stop raising rates. And I mean, it seems like there are some things that you can see, especially if you wait. Are you in the camp that there's a lag effect to the hikes and that we're going to see these things, or are you in the camp that inflation is just too high?
So I take both sides of that argument. I'm going to sound like a typical strategist. So I think they should pause. You've had a lot of rate hikes. We're at 5% now from 0 a year and a half ago. That does have a lagged effect. Some would say 6 months. Some would say 12 to 18 months. You are starting to see an impact on credit conditions. Banks are pulling back on lending. Obviously, some of the issues we saw earlier this year are having an impact as well. So why not wait? Why not give it a quarter? Give it a meeting or 2 meetings to wait and see what the data comes in at. I'm not sure why you need to do another rate hike. I think the problem this time around versus previous rate hiking cycles, whether it's over the last 10 to 15 years, is that because inflation is stickier, the Fed, when they pause, they're not cutting rates back to 0. It's not a hike to 5 and then 0. So I think that's something the market is going to struggle to sort of wrap its mind around, sort of a recency bias from what we've experienced over the last 15 years. So I'm definitely in the pause camp. There's no need to continue hiking. We definitely think a slowdown is coming, whether it's another 25 bips or they pause and that's it.
One other thing that is referencing a discussion we had yesterday, John, was about 2024 earnings. And we had someone on that said, we're not going to really see a hard landing this year, but we might see one next year. Aren't people writing off 2023 as being sort of a flattish year for S&P earnings? But they're supposed to come back like 11 or 12% in 2024. Do you think that's going to happen? Or are estimates too high?
I think estimates are way too high. I mean, I think the problem with inflation is as long as you can pass through those input costs to consumers and maintain your top line, your earnings are going to be okay. But at some point, those input costs are going to start to bite as consumers pull back. So you get positive operating leverage in the early part of an inflationary cycle, and then it becomes negative operating leverage leading, as the cycle matures. So I think, unfortunately, the estimates are too high for the remainder of this year, and they're still too high for next year. And I don't know what the right number is. We don't forecast an estimate for S&P 500 earnings, but the numbers for this year at 220, I think, are way too optimistic.
Can I sneak in T-bills or Bitcoin? John, which one would you rather?
Bitcoin.
T-bills. Much easier to analyze, Kelly.
No, but not just for an election. What would you do if it was your money?
He's an establishment guy. Of course, he's saying that. He's a
Bitcoin
securities
is the
industry.
establishment. It's all institutional investors.
It's going to disintermediate all these people. Of course, they hate it. That's why Jamie Dimon hates it.
AI is going to disintermediate us, not crypto.
Yeah. Meanwhile, T-bills are literally cratering the banking system.